and welcome to Sectors Up Close. I'm Elena Casas. Our focus today is on US real estate investment trusts, and my guest is Patrick Healey, the president of Caliber Financial Partners. From rural farmland to data centres and from hotels to prisons, there are a dizzying array of real estate investment trusts to choose from. The concept is simple. Invest in a REIT and sit back and enjoy a slice of the rents without the hassle of being a landlord, while your investment is secure in the properties behind it. The S&P 500 REITs index is up 11% so far this year and still delivers dividend yield of 2.8% according to Refinitiv data. But not all REITs are the same. As you can see, only one of the largest 5 REITs on the S&P 500 is residential. There are some sectors, notably office space, which may lag, while others, such as multifamily residential, may be overvalued as investors hunt for yield. So, how do you separate the winners from the losers? Let's ask Patrick Healey of Caliber Financial Partners. Patrick, hello, thanks for joining us. The pandemic has of course shaken up the real estate market in the US, so which sectors are in favour now?
So as you pointed out, a lot of the names have traded up in rebound coming out of COVID, but I really focus in terms of the primary property types. I think industrial has had a ton of tailwinds as people get more comfortable with e-commerce and that trend grows. I think that trend will continue and has really accelerated coming out of COVID with people really shopping from home as opposed to going to stores. Multifamily, while it is stretched in terms of valuation, I think the demand in our housing market continues to support property types in multifamily, especially in the Sun Belt area. And so I would be looking at those in terms of the sort of the primary 4 food groups, if you will. Among specialty sectors, I am a big proponent of self-storage, which kind of naturally fits in with multifamily as well. And then other property types like cell towers and data storage. I think those fit well with, again, e-commerce and a more mobile economy.
So which subsectors should we be avoiding? Are office REITs a bargain at the moment, or should we be staying well away?
I am steering clear of office for the time being, and particularly office in metro areas. I think if anything we learned out of COVID is people are adapting to a more of a hybrid or work from home model. I think there will be a recovery to some extent in office in metro areas. However, I think landlords will have less pricing power when they look to release those properties. Companies may be taking a smaller footprint, or they may be in a more advantageous position in terms of negotiating those rents down. So as a landlord in office, I'd probably avoid right now.
What are your recommendations then? How do you choose quality and avoid traps?
Right, so it's not as simple as just looking at the current dividend yield. I think you have to look at the underlying strength of the cash flows, or what's known as funds from operation, which is a metric in REITs. And I really focus, I think, not just on current dividend yield and having a nice spread over the 10-year treasury, which is something that I think yield-based investors look for, but also companies that are able to grow that dividend over time. And so you look for property types that have a really good supply and demand balance, and also companies that have strong cash flows where they're able to grow their net operating income and then ultimately pass that along in terms of a higher dividend yield in the future to investors.
So what are your specific recommendations?
So a few names that I like on the property types I touched on earlier. One name is Iron Mountain. They are a data storage REIT based in Boston, and they offer a pretty attractive dividend yield north of 6%. And they're a mid-cap name, and industrial's been hot for M&A activity, and so they may actually be a good takeover candidate by a larger firm. And in the meantime, they're paying you a pretty nice yield. So that's a name that I like. And on the industrial side, there's a company called Stag Industrial, north of a 4% yield. Again, also based in Boston. But I think those types of sectors are ripe for consolidation, and the yields that they offer in the meantime are attractive.
Thanks so much for that, Patrick Healey, president of Caliber Financial Partners. Well, before I go, here are some of the top stories in this space. Shopping centre owner Kimco Realty said it will buy rival Weingarten Realty for about $3.9 billion to bulk up as more parts of the US economy reopen. The deal will create a company with 559 open-air shopping centres that sell groceries, which has been one of the better performing parts of the sector during the pandemic. British Land says it's exploring further opportunities to buy retail parks and is looking to invest more in its urban logistics portfolio. The company cited customer confidence in visiting open-air retail parks where social distancing can be more easily managed. British Land said it expects returns on covered shopping centres to take longer to stabilise due to higher costs and lower footfall. And Globalworth Real Estate is advising shareholders not to take any action over an unsolicited takeover offer by its two top shareholders. CPI and Around Town of Germany offered to buy the 49% of Globalworth they do not already own, valuing the London-listed owner of offices in Eastern Europe at about $1.9 billion. Prior to the offer, Globalworth shares were down about 17% this year as the office sector continued to struggle. And that's your roundup of the REIT sector. I'm Elena Casas, and this is Reuters.